Hi everyone, I'm really excited that you're with us today because I'm here with Charlie O'Donnell, the founder of Brooklyn Bridge Ventures. Thanks so much for being with me, Charlie.
No problem.
So Charlie, one of the first questions that you like to ask your founders is about their families and about what their parents do. So I actually want to go back a generation further and ask about your Nana because I'm really close with my Nana and I've seen so much on your social profiles about her. What's the best lesson you've learned from her about living a meaningful life?
So, just to provide a context for those of you who don't follow me on Instagram and don't see my Nana videos, hashtag Nana videos. She's the little old white lady, just because there's a couple of them, and I was like, whoa, that's definitely not my grandmother. But um, she is 97. She just recently gave up her car. She learned to drive at 55 years old, and lives on her own, is very independent. And I think for me, interacting with her just is a constant reminder of the very like simple things. You know, when I'm fundraising for my fund or I'm dealing with some tough negotiation or trying to make a decision about a startup, there's very few things sometimes that can cut through all that noise. And the practice of making time for her is just something where nothing else seems really that important, to be honest, you know. And I think it's sort of I have a very clarifying experience when I'm with her because, she's seen. I mean, think about it this way: I got her the New York Times reprint of the day that she was born, so February 14th, 1918, and the front cover, the headline is "They're chasing the Kaiser around Europe in World War I."
Wow.
So just when you think about like everything that she's seen over time and the world changing and just the scale of the world when she was young and the world the way it is now, it just makes following the latest funding for the latest convenient app seem kind of insignificant, and I think it just provides a lot of context. So I think what I've learned from her is not so much a specific lesson that she talks about, but just her whole existence and the length of time and amount of change and what really rises to a level of importance, I think is key for me.
Okay, so I had to include Nana, but now I really want to move into your work at Brooklyn Bridge. You give founders some of the first money that they'll ever raise, which is huge. Can you just run me through your typical day, starting with the 2 degree biking?
Yes. So I generally bike to work. I have about a 20-minute bike ride from Bay Ridge in Brooklyn to Gowanus, which is where I work out of a place we affectionately call the townhouse because it's a townhouse. And there's about 20 sort of indie freelancer, software developer, designer types who all split this 4-story residential building, and we use it as a co-working space. So I tend to bunch up my meetings in the morning. I try not to take afternoon meetings, although I'll squeeze in one or two sort of at the end of the day before I go and do whatever I'm doing after work. Because I feel like if I batch my time, I can be more effective. So I'll do about 3 meetings in the morning, but they're not necessarily pitches. In fact, I probably do less pitches than the average seed investor. I probably only do 2 or 3 a week. I think I've gotten really good at picking out the things that I'm most interested in, and I value founders' time too much to take exploratory meetings or take a meeting as a favor, even though I'm not really interested in the company. So out of the 1,800 or 2,000 things that I might be aware of or be in my inbox over the course of a year, I probably only take about 170 pitch meetings a year. And so, and I look to do about 10 deals from that group. So if you've taken a meeting with me at all, you've probably got a 1 in, 17 shot at getting a funding round. So that's pretty good, actually. It means I could actually see investing in your company and that it's yours to lose. Unfortunately, most of them lose it in the context of a meeting. But I take a lot of, one of the things I love about my job is I take a wide variety of meetings because I sort of play the long game when it comes to building relationships. So whether it's not just talking to other investors, but just interesting people doing interesting things. The other day I met with this guy, John, who wrote the definitive book on the paleo diet. And, we sort of peripherally share food interests. I'm a 4-Hour Body guy, and but he's just sort of an interesting dude. And somebody introduced me to him, and I'm looking at a food technology investment. He has an interesting network of people around him. He's just sort of an interesting guy. Kind of looks like a caveman, actually.
Works for paleo.
Yeah, it totally works, right? And this is a guy where I was able to introduce him to another founder who was doing sort of a pre-prep food business in the healthy living space. And this was a founder who introduced me to Carolyn from Plumprint. So, you're sort of investing in the karma around the ecosystem. So, A, I enjoyed my chat with him. B, I was able to hook him up with somebody that he found interesting and was able to help somebody who had helped me. C, he sees interesting stuff and he's connected to a group of interesting people. So you never know when 6 months down the line, he's like, oh, I was, meeting somebody at this food tech investing conference and that you might want to talk to them. So, the subject matter of each of the meetings really jumps around. It's not all just pitch meetings. And then, in the afternoon, I try and leave like big blocks of time to actually like get work done. So it's, going through email or working with the contractors on my team to run an event or something like that. And so, while I'm the only full-time employee at Brooklyn Bridge, I have recently hired somebody to help out on a contract basis with events. I have a fantastic assistant named Marcia.
She's great.
She's fantastic. I would not be able to do my job without her. And so, and then I have a very structured method of working with my portfolio companies. Generally, we'll do a meeting sort of every 4 weeks, and then every 2 weeks in the in-between weeks, have a quick call and just to check in. And sometimes we don't have anything to talk about, but at least they know that that's there. Yeah, obviously they can call me in an emergency or just, drop a text or an email. But sometimes there's stuff that isn't immediate, but they want to have a little more extended conversation. And so instead of going through Marcia and figuring out when we're both free, they know that like I have that time and we can just, sort of check in quickly or get some stuff done.
Right. One of the things you mentioned, Charlie, is that you take these meetings, even if they're not related to what you're doing at the moment, because you never know what's going to happen, and you enjoy yourself. One of the really cool things that you've been doing, in addition to everything that you're already doing, is sending out an email to a group of investors about current investments that either you're working on or just upcoming things that you think are cool. Can you tell us a little bit more about that?
Yes, the VCC, I always say this, the VC-BCC email. And it's actually a little bit of an inspiration from what SV Angel used to do probably about 4 or 5 years ago. This was in the days before AngelList, and they would literally send out their deal flow. And so you could sort of pour through one of the top seed investing firms in the Valley and just see everything they were looking at and everything they had prioritized. And why not, really? I mean, they had secured their reputation. They knew they weren't going to get bumped out in the deal as the person who was sort of sending it around. And it was to their advantage to be a place where if you got them on board, everybody else jumped on board too, right? And so the more that I can help my companies syndicate their rounds, because I'm not doing the whole round, the more I become a person who you might want to see the opportunity to do first. So what I generally do is, I'll say that I want to invest in a company, and let's say they're raising like $1 million, and I'll do 250 of that. If I'm interested in the company, I give them a term sheet or show my interest, and they need help raising the rest of the round. I'll put it in this email that I send out to people I've worked with before, or people I respect or would like to work with, and just say, hey, I have an opportunity in this space, or maybe I'll name the company or give a little pitch. And the reality is it's very tough to keep track of which seed funds are invested in which areas and what do they even count as seed, and does it have to be a need a product, or can it be pre-revenue, or all the different variables of specialization, which I've kind of given up on tracking all that and said, look, all of you, like, here's what I'm working on. And actually, the last one I sent out, we just finished out the last 125K of a round. And it was from one person who had already met the company and kind of gone radio silent. And another person who, to be honest, like, I'm not even really that close to. We kind of know each other from Twitter. And he jumped in and was like, wow, this company sounds really exciting. I'd love to get to meet them. And he finished out the round. I probably never would have thought to introduce the company to that investor. But, I just happened to hit him at the right time.
Very cool. So I want to shift gears for a couple minutes and talk about your journey. You've really chronicled it on This Is Going to Be Big, which is your blog that I mentioned you've been doing since 2004, which I just think is so impressive. Next, I want to talk about the one post I mentioned to you about finding yourself and how you measure your career. You've had tremendous success. You've worked with Union Square Ventures, started your own fund, you were at first round, but it's not been that easy to get there. Mm-hmm. How do you measure success for yourself? For people who haven't read that post, can you give us a glimpse?
Sure. I wouldn't necessarily characterize that I've had tremendous success. I'm happy where I am now, and there's certainly a lot of people who would like to get into venture, and I'm there. But, I would have liked to be a Major League Baseball player, and I didn't get there, right? So the grass is sort of always greener. And I still think of my venture career as basically being ahead of me. And this is my first fund that I'm working on. I'm about to start raising the second fund. And, so I always try and keep a context of like, where am I now and where have I been? And at different points, I felt like I was above or behind where I could have been at that period, right? So when I was 25, I joined Union Square Ventures, which I guess sounds kind of impressive now, but at the time, Union Square Ventures wasn't Union Square Ventures, right? This is USV pre-Twitter, pre-all the investments you have come to know and love that they've done, right? This is, when Fred Wilson wasn't necessarily a household venture name. And so I actually took a tremendous amount of firm risk to join them, right? I wasn't joining Sequoia or Kleiner or Bessemer or any of these other funds. This was, kind of an upstart New York-based fund that didn't have the easiest time fundraising its first fund. Anybody could have gotten into that first fund, right? That first fund is one of the best performing VC funds of all time. And if you were an accredited investor and you seemed pretty reasonable, you could have gotten in, right? This is, before a lot of their success. And so that risk paid off. And I felt really good to be at this up and coming firm at the time. When I was 30, The day I turned 30, I was the CEO of an angel-backed startup that had about a month or 2 months of capital left in it, wasn't going anywhere, in the middle of a really difficult fundraising environment, and pretty much was headed for a shutdown. We were headed for the dead pool. This is before anybody even mentioned the term acqui-hire. Facebook wasn't out there buying teams yet. And I had previously worked as a product manager for a year at a company that also kind of went sideways. And so I sort of felt like from 25 to 29, like I definitely didn't go up. I felt behind where I was given the context of my age. So that didn't feel great. Although I had a conversation with my friend Jason Schwartz, who is a great product manager and teaches at General Assembly and does a lot of consulting. And he had said to me he was envious of where I was. And I was like, well, what do you mean? My company has no money in it. It's not going anywhere. He's like, yeah, but you built something. You did it. You earned your stripes. You raised money. You hired people. You launched a product. And he had previously worked for other people's companies before. He's like, yeah, I could point to things I've done, but it was always for other people. It was never mine. And so I guess, it was a good opportunity to sort of reflect and be proud of, at least getting that far. But the reality is, those lessons that I learned as a founder go into how I deal with founders every day now. And so that was a valuable set of experiences I had that has gone into making me the investor that I am today. And it was that difficult fundraising environment that led me to helping Foursquare raise their initial round of money. And that put a spotlight on New York, and it helped connect me to first round capital. And that's how I got that opportunity. So if my company was really successful at the time, I never would have gone back to VC.
And that goes directly into where I want to move now with investing. I'm just learning about investing, and I know there's a lot of people who don't know too much about it. For people who are inspiring to be investors like you or just want to learn more about it, what does it take to start a fund? So when you were going to start Brooklyn Bridge, what does that take? Because I know that takes a lot of courage.
So, yeah, I never really thought of it as courage because I sort of feel like I'm employable, right? Somebody will pick me up for something. I have some skills. So, like, what was the worst that could happen? That I could attempt to fundraise and then it wouldn't work out, and I would pick up some credit card debt and go to work for some big company and then pay it back. Like, I wasn't going to go homeless, right? And so that's not that bad, actually. So I don't think of that as particularly courageous. I mean, my dad was a fireman. He ran into burning buildings. Like that's
Courageous.
just yeah. I think the keys are, and I used to fund funds. I used to work at General Motors pension fund, actually evaluating VC firms. If you're not going to start out with money and just decide to like write checks on your own account, you've got to have a really clear strategy. You've got to be able to explain to somebody why you're going to access the top deals. Access is a huge part of it. It's really hard to do without a track record. I had 2 exits. I only led 7 deals for first round, but 2 of the companies, GroupMe and Single Platform, had successful exits. Yeah, and so that doesn't usually happen when you've got a 2-year track record. But I think it was that second exit, especially for a B2B company like Single Platform, because people could look at GroupMe and say, well, it was a consumer thing, and those things seem to get randomly bought every now and then. But Single Platform was a company that had real revenues and was growing, and is still growing today under Constant Contact. And so I think it was that track record that was key. And I think for me, the other thing was PR was big. I probably raised about 60% of my fund through direct connections that came from articles that were written about the fund. And so important people read cranes. That was a really good lesson in the New York business world. No one ever thinks of pitching cranes, but there's a lot of people in the finance and real estate and those types of worlds that aren't really connected to the tech community that find this stuff really interesting. And then that was another big lesson too, is wealthy people trade their money for interestingness. And you can't think of it as taking money. You have to think you're offering something. You're offering an opportunity to get into some interesting investments. And you have to realize too that fund investing is kind of boring actually. And so if you can create an interesting experience for an investor, because you're dealing with people who don't need to invest in you. They don't need more money. So why would they join this fund? And that's been a big focus too. So I've done co-investments with half of the companies I've invested in. I've gone in side by side with my investors. So I'm providing them angel deal flow as well as an opportunity to access the community and the players in the community. We do a bunch of events and dinners, and so it's more of an experience than just handing somebody your money and getting the reports on a quarterly basis.
When you talk about that experience, you've been very open about, and I know a lot of investors are, founders building a relationship with you versus me emailing you, say, hey, Charlie, I have this cool startup. Can you write me a check? So it's like building a real relationship. What's some advice you have for how founders can build a relationship with you or just any investor?
Social media is big. It really does not take that much to kind of hang around the rim in conversation. And so, there's a lot of people who I've met because, they make an interesting point or, I just got an email from Steve Poland, and I've never met Steve, although I've known about his existence for, it's got to be at least 8 or 9 years. I know he's sort of north of Westchester somewhere, which is mostly Canada as far as I know. But he's in Buffalo or one of those cold places. And, he just dropped me a line and let me know he was putting a fund together and wanted to share deals. And I already know who he is, or at least I know he's a smart, interesting guy, and I don't know that because we've had a conversation. I know that because I, see his posts around. I know he used to post about different startup ideas, and there's a whole bunch of other people who fit into that category that I, connect up with over Twitter, and they're just authentic and responsive, and they're not just retweeting every post, but they're commiserating on the Mets, or they're talking about biking, or, if I'm biking, I'm always looking to see whether Sebastian Delmont also bikes, because he's a cold weather biker like I am. And I met him peripherally because he did some Android work for GroupMe back in the day. And, we've stayed in touch since then. And, social media is a great way to kind of keep pinging and keep that heartbeat alive until you've got something that you think is worth talking about.
One of your most recent investments is in Brad Shellhammer's Bazaar, which is super cool. And I'm excited to learn more about that. One of the things you wrote about in the post, that really intrigued me, was that he told you that it's not going to be $1 billion. He's not expecting it to be $1 billion company right now.
$1 billion business.
What?
He said it doesn't have to be $1 billion.
Okay, it doesn't have to be
$1 billion.
It doesn't have to be $1 billion business, and I was really intrigued by that because I read, in the span of a few weeks, I read something that says VCs only want to hear about $1 billion businesses. And then I hear some people tell me it doesn't have to be $1 billion business. You should pursue it if you're passionate and if it can make a difference. So for people who are new to the game, Charlie, it gets really confusing about what to pursue, what not to pursue. What's your take on that?
Well, it depends on the fund size. And so the economics of a $1 million fund like I have are such that, a $1 billion enterprise business returns the fund 3 times over. That's not to say that any of the other 33 investments will, do anything, right? So, but if you have a $100 million fund and you invest in $2 billion businesses and somehow maintain 20% ownership through the whole life of the business, you still haven't even returned your investors' money back. Fund size really affects the size of the opportunities that you can go after. To Rebecca Caden at Maveron, and who's terrific, and I was asking her what they think about in terms of the size of the opportunities that they're looking for, and she told me that their calculation was that a core bet has to be able to return at least half the fund. And their fund is something like $150 million. So if it returns half the fund at 75, if they had 20% ownership, you're talking $350 million exit, right? So for $150 million fund, they're looking at something that, has the potential to be at least 350, if not more. So, it really depends on fund size. Now, that being said, not every business has to be venture backable at all. So a lot of times people say, well, I don't think this is a big business. Well, a VC will say that if it only throws off $5 million a year in free cash flow. Well, I don't know about you, but I don't make $5 million a year. And so if I owned 100% of a business that threw off $5 million a year, I'd be in pretty good shape. That doesn't mean it's not a business. It's just not appropriate for the fund size of a particular VC.
Got it. Thank you for clarifying that. So I know you're super busy, and I just have a couple more questions for you. One is from our audience. Liza wants to know if there are any startups right now that you're really excited about, some up-and-comers.
Yes, all of the ones I've already invested. Some of the ones I'm most excited about, I don't think we've publicized the investment in. So I have to think about which ones I can actually talk about. I'll say this: So I'm always pleasantly surprised as to which areas I get presented. Right, so I don't have I'm not really big
just
into
consumer
or really doing consumer or really into B2B SaaS. I just tell people to surprise me. So I'm looking at a company that makes food, and they have a really interesting logistics and technology stack around that. It's not software. It's literally the atmospheric conditions and the place they prepare the food. And so that's exciting. It's a different kind of tech. And
can you give us the name or no?
No, I can't actually.
I'm super into food, so that sounds awesome.
I've been eating the food for the last couple of months. Yeah. But I think the key to the businesses that I'm most interested in is that the founder has a unique perspective on the problem. And so one founder is an aerospace engineer who is looking at a logistics problem. Another founder is a African-American female doing a business in the hair market, and hair is a big thing to her, and it has been for a long time, and she's got more than an interesting perspective on that space. I just backed 2 parents to do a distributed network of kids classes with really interesting economics and implications for inspiring creativity. And so they're all the absolute right person to be doing that particular startup.
Great. So I want to end with the same question we always end our 33 Founders episodes with. And yours is going to sound like a morbid introduction, but it was from your post, so I'm not taking responsibility. The second post you have on "This is going to be big" was about taking your grandmothers out.
You're going way back. I'm afraid of what this is going to be.
Going back to 2004. So the post was about taking your grandmothers out for their 86th birthdays. And you had found on an online death clock, which I didn't know those existed.
Oh, July 9th, 2065.
65, yes. That life was going to end right before your 86th birthday.
Mm-hmm.
So, God willing, that won't be the case. But when I read it, it reminded me of something that my friend said when I was asking him about uncertainty. And he also prefaced it morbidly. He was like, Jenna, we're all going to die. So when you think of it that way, it really puts things in perspective. Your business is so uncertain. You have no idea. There's no little book telling you that this startup is going to be successful, that you're putting your money behind. How do you make sure that your perspective isn't ruled by uncertainty?
It's the portfolio effect. While I am not certain on any one particular company, I'm nearly 100% certain that I'm not going to go 0 for 30. It is, I'm only aware of one fund in the history of all venture capital that has literally failed to return anything. I'm not going to say which fund it is, but it's, and it was right in the middle of the whole dot-com thing, and it was a complete wipeout. And so a bad fund returns 50 cents on the dollar, basically. And a good fund, you know, most investors will be happy with 2x, although I think given the risk, they should probably be getting at least 3x return. You know, you've got firms like the first USV fund is probably at least a 20x return, but, you know, to get up that high is pretty improbable given the fact that it's a diversified portfolio. So I'm pretty sure I'm going to fall somewhere in the 50 cents to 6x. You know, I probably have a 95% certainty it'll be in there somewhere. And so, you know, I play the percentages, and I figure if I'm investing in 30 smart, compelling, insightful founders in big enough spaces at single-digit valuations, I'm pretty sure I'm going to do okay. And so I don't think about it like a lot of uncertainty. I think about it like a portfolio investor. There's always some uncertainty to something, and I'm trying to de-risk it in the best ways that I know how.
I love it. You can go back and tell 24-year-old Charlie about the portfolio effect. It's a great one.
There you go.
And then the last thing, which I don't know if you'll do, but this was just more of my research. I heard.
I'm not going to do it on camera. I know exactly what you're going to ask.
Is it the Rocky impression?
It's in my bio. I know where you're going with this.
All right. Well, we won't end on that, but can we end with you just letting people know how they can subscribe to the blog and just stay up to date with everything you're doing?
Sure. My blog is This Is Going to Be Big, and I'm CEO NYC just about everywhere. And yeah, then email me. And if I don't email you back right away, then just feel free to forward it to me again and just say, hey, not sure if you saw this.
All right. Thank you so much, Charlie. I really appreciate you being with me today.
No problem.